Great. Thank you very much, Monique. Thank you all for being here. It's always a pleasure to speak to the AICPA. My father and grandfather, both who had been CPAs, were members of the AICPA. So it's always a pleasure to talk to y'all. And what I'm going to talk about today, though, is focusing on the tectonic economic, financial, and technological shifts that will shape the decade ahead. And the key way I want us to think about what's going on now, how it shapes the future, and what's coming next is to break it down of headlines and trend lines. On the headline side, what are the economic upsides we see right now? First of all, the labor market is strong. Services are contributing positive to GDP. There have been some different things happening in GDP reports, but economic growth is still being supported by services consumption of individuals, of consumers. Manufacturing, even though it's now weakened quite a bit, is showing still a very strong backlog. That's going to be positive for the year ahead. And mortgage credit quality is high and debt delinquencies are low. I'm going to talk a little bit more about these things during the course of our conversation. As we think about what's going on now, how does it shape the years ahead? On the downside, though, year-on-year inflation rates are sticky. CPI is still 7.7% year-on-year. And even though people have breathed a bit of a sigh of relief, we see that in some rebound in the equity markets, this is still a lot higher than the Fed's 2% target. We'll talk more about that. And of course, the reason that the Fed is going to continue tightening rates is because we're so far away from 2%. Global growth is also slowing. That's led to a reverse in a wealth effect and expectations that investment will slow. Obviously, business investment is very sensitive to interest rates. Plus, at the end of this year, we begin to see the end of that Section 179 depreciation, or at least the phase out begins. We're no longer going to be at 100% for those purchases above $1,050,000. Beginning next year, it'll be 80%. So you see that that bonus depreciation begin to be reduced in the years forward. That could impact some investment decisions as well. Could lead to a pretty good Q4 here, but might be, in addition to the higher interest rates, something that weighs on early in the year. We also have pretty high risks of a global debt crisis. And then I'll talk about, tied into that, Cold War II, and looking a little bit further out, the concerns about Medicare and Social Security insolvency. I know you're thinking about not just what's in the economy, but also from an investment standpoint, what are going to be some of the big trends? You also need to be thinking about what are the risks. And this is kind of how I see things right now. That's what we're going to talk about. So let's start with the good news. Jobs, right? Most recent jobs numbers showed the November employment report, 3.7% unemployment. You can see the graph here on the left-hand side is the unemployment rate. Come down a lot. We're near very low levels. It was just a couple months ago in September at 3.5%. That was the same rate it was in February of 2020 before COVID, which had been a multi-decades low. Even at 3.7, this is a really low unemployment rate. On the right-hand side of the graph, you see non-farm payrolls. They were up 263,000 in November. That's more than was expected. It's a solid number, 263,000 net new jobs. That's really good. And if you look at the blue dots, what you'll notice is, gee, the blue dot we're looking at right now is an all-time record high. In other words, there have never been more people in the U.S. working ever than there are right now. Big part of this is private payrolls. Private companies have been hitting records for a number of months. There's still a deficit actually in government employees. So the government, in such a tight labor market, is having trouble competing with the private sector to attract talent. And there's still hundreds of thousands of a deficit in terms of how many open, unfilled government jobs there are, how many how big a drop there is in those government payrolls compared to where we were before COVID. 300 to 400,000 is how many more government jobs have to be added just to catch up to where we were before COVID. Meanwhile, private payrolls really strong. Now, against the backdrop of strong jobs, layoffs have been getting a lot of attention. These are quarterly layoffs, especially focused on the tech space. This is from layoffs.fyi. The red bars represent the number of employees laid off. That's the left axis. The right axis here is the companies with layoffs. And of course, this is by quarter. What you see is the most recent 4 quarters, there's a lot of layoffs there. And it's a lot more than it was even in 2020. So this is getting a lot of headlines really because we're talking about very high paying, high education jobs that are being cut from very big name companies. There's still a massive shortage of workers in a lot of different roles. I think about the many open positions in manufacturing or construction, in healthcare, in trades, in commercial driving license roles, trucking. All of those things, you still see lots and lots of unemployed workers, lots and lots of open jobs, and there's not enough workers. Whereas these unemployed workers, there's a lot of crypto bros in here, right? So we've got this weird thing going on in the labor market where we're at very low unemployment rate, record non-farm payrolls, lots of layoffs, which is a sign, I think, of some slowing to come. We do expect the unemployment rate will go higher, but this is still a really low unemployment rate. Now, if we think about what's going on in labor force participation rates and the rest of the economy, those participation rates have come down a little bit. But if we look at who's losing jobs, even with the recent layoffs, we see the most recent data from last week. There's some data out today showed 230,000 people filed for unemployment in the most recent week. That's really low. And the all-time record low for jobless claims is 162,000. If we look back, that record low was set in 1968. Since then, the labor force has more than doubled in size. In other words, on a labor force adjusted basis, the all-time record lows of people losing their jobs in a given week and filing for unemployment is right now. So the labor market is really tight. Not many people are losing their jobs and filing for unemployment. And yet, we do have these, pretty big headline grabbing announcements of layoffs. We do expect there's going to be more slowing in the year ahead. We're likely to see layoffs in finance accelerate as well, but we could see a lot of in-person roles, blue-collar roles, many different roles remain unfilled. And this is partially because the labor force participation rate's been falling. There's a report out just yesterday from the Boston Fed. I actually posted about this on LinkedIn just yesterday. And one of the big things is we're seeing people have left the labor force, especially there's a large number of men in prime working age between the ages of 25 and 54, especially those without college education. We're seeing the record numbers of those folks have left the labor force. And this is, I think, one of those key things to keep in mind. People are like, well, how do we address the future of the labor force? One of the key things to keep in mind is that education pays. This graphic comes from the U.S. Bureau of Labor Statistics. There's a huge debate about this, and I think the debate is ridiculous. There are a lot of folks who have been saying that you don't need to go to college to have a successful career, and that's true, you don't need to. But statistically, at the population level for the whole country, what this graph shows is on the left, the more education you have, the more money you make, right? The more you earn, the more you learn, the more you earn. And on the left-hand side, the more education you make at every step, the unemployment rate goes down. So you're more likely to make more and less likely to be unemployed if you get more education. As for the labor force participation rate and drop off of men without college education between the ages of 25 and 54, those folks have dropped out of the labor force, which means if you get more education, you complete a 4-year degree, you're also much less likely to be a labor force dropout. And those are folks who aren't just unemployed or employed, they're folks who aren't even looking for a job. That's what it means to leave the labor force. So the labor force is really defined as people with jobs or without jobs and looking. These folks are just gone. The argument around this, though, I think is just ridiculous. It will continue to rage on because the cost of education is high and because there's always folks who don't want to put in the effort to get more education. I know many of you are here getting your continuing education credits. The more you learn, the more you earn always. And the reason I put education pays up here is because the actual website from the Bureau of Labor Statistics, if you want to just Google it, is education pays, and it takes you right to this chart. This is based on population level data for Americans 25 and over. So there's a very large survey sample. I think it's 60,000 workers in which this data comes from. Now, while that's some of the more positive things to think about in the labor force and in the job market, I'm a little bit concerned about a couple of things when I think about demographics in 2026 and beyond. So if we're thinking about what's going to be important for the decade ahead, I think it's a couple things. Number one, in 3 years and less than a month, baby boomers start turning 80. Gen Xers start turning 61. Millennials will be 45 and Gen Zers will be 29. This starts happening in 2026. Like I say, just a little over 3 years away. And once baby boomers are 80 and Gen Xers are 61, their exodus is from the labor market, for boomers especially, quite complete. Gen Xers, the exodus begins. And now it's millennials, Gen Z, and Alpha that really become the biggest chunk of the labor force. That's going to start happening here very quickly, and something most people aren't quite focused on, but it's going to be really, really important. Those generational shifts are going to happen. The other important thing that happens in 2026 is, for a number of years now, that's the year that's been forecasted to be the year when Medicare hits insolvency. So if you're focused on retirement planning, this is really important, because since 2018, the drop dead year for Medicare is 2026. That's the year when insolvency hits and there's not enough money in that health insurance trust fund to self-fund. It's going to start pulling in the operating budget even more than we see entitlements already pulling on it. That's going to be a problem. Social Security is not that far behind, so we're taking a 10-year look. Insolvency for Social Security, 2034. That's going to be a huge problem. And of course, if we're not, anytime we have disruption in the labor force where there's people getting laid off, people not working, that's less money going into payroll taxes. Less money into payroll taxes means the self-funding mechanisms of Medicare and Medicaid come under greater pressure. Something to keep in mind, going to be really, really important looking forward. And of course, as we think about the insolvency of Medicare in 26 and the insolvency of Social Security in 34, we're looking at $32 trillion in the national debt right now. That's a lot. And it's gone up a lot in recent years. It took 205 years for it to hit 1 trillion, but now it just continues higher. And of course, the higher interest rate environment will make refinancing this debt more difficult. It's one of the key reasons why the Fed is pushing so hard to get inflation down. Because if inflation comes down, eventually those interest rates come down. And with lower inflation and lower interest rates, this is more manageable. If inflation becomes more rampant, gets worse from where we are now, or if the Fed has to raise interest rates a lot more to little or no effect, managing this historic debt burden will become a much bigger problem from just a cash flow for the country, thinking about how does the government finance all this. So those are some of the things about the labor market, the demographics, the government budget. Inflation is also, as I mentioned, quite high. The blue line here is the current level of CPI. You can see it here on the right, October 2022, 7.7%. The next report will be released next week for consumer inflation. This is what the average consumers are paying. It's a basket of goods. We do expect this rate will get back down to that sort of 2 to 3% range. If not by the end of next year, then the year after, late 2023 or 2024, we're likely to get back down to more normal levels. But we're really high right now, right? The Fed's target is the red line that doesn't even fit on the graph at 2%. So we are a long way from home, and the Fed is going to likely be raising rates several more times. We expect a 50 basis point rate hike on December 14th. The key CPI report to watch will be the day before on December 13th. We also expect a rate hike of likely right now 50 basis points on February 1st with a potential 25 basis point rate hike in March. So we could see that happen. There might be rate cuts at the end of next year. Depends how drastically business investment slows. But the big, long staying power of Fed policy here is that the Fed is committed to that 2% level of inflation. Even back in June, when the blue line here was at 9.1%, Fed Chair Powell said that they wanted to get not just the red line, the core CPI that's on this graph. They wanted to get that blue line, the 9.1, back to 2%. If the Fed demonstrates that commitment, that will be really, really critical for financial stability, for interest rates, and for really shielding the country from some of what could be extremely deleterious impacts of record debt levels that threaten to go even higher. This is why this is the Fed's top priority. Plus, jobs are really good, and the Fed has two mandates. Full employment, which we're clearly at. We've got near record level numbers of how small jobless claims are, right? These are record lows on a population labor force size adjusted basis. And we've got record high numbers of payroll. So lots of people working, very few people losing their jobs, but we also have very high inflation. One of those things has to give for the Fed to stop raising rates. Either the job market has to weaken or inflation has to fall, and only then can really the Fed have the license to pull back. The Fed doesn't care about, they care, it's not part of their mandate. Equity markets, home prices, the dollar, oil prices, none of that stuff matters directly for Fed policy. The only things that matter directly are full employment and low stable prices. They're trying to get this back to low stable prices. That commitment, demonstrating that, reaffirming that, is really important for the financial stability of U.S. and global financial markets in the decade ahead. And I do believe the Fed is committed to trying to get us there. How quickly they can get us there is going to be that big question. Is the end of 23? Is it 2024? When do we kind of get back down towards those numbers? 7.7 still a high inflation rate, means the Fed's going to raise rates more. But they're not abandoning the 2%. That's a critical decade ahead thing to be thinking about. Give you also some idea of how high the CPI right now. It's still the highest since January 1982. The other thing that's going to be really important for shaping the decade ahead and ties into a number of these different market impacts is Cold War II, something I've been talking about for a year and a half, 2 years now, long enough to have been able to trademark the term. And it all starts, though, really this year, kicking off, ramping up with a wedding. A wedding many people didn't notice because something else was going on. The Olympics were going on this past February, and on February 4th, Presidents Putin and Xi at the Olympics issued a joint statement, which you can read on the Kremlin's website, which said there is no limit to their commitment and that they defend the outcomes of the Second World War. So this isn't like a Happy June wedding, right? This is more like a Game of Thrones kind of wedding. And the implication here is, this is the map at the end of the Second World War, which seems like a pretty weird thing to reference so many years later. Like, this is 77 years after the fact. Seems kind of weird, but whatever, except for China was bigger, Russia was bigger. And thus began later in the month of February, Russia's war on Ukraine, and a push which still remains ongoing. These are the maps from yesterday. You can see the eastern part of Ukraine that is still under Russian control. That's in the red. And of course, they've moved to annex several of the areas to try to justify that this is now Russian territory and international law, which, that's not widely being accepted, right? That's been pushed back against by the UN and many, many countries, especially, of course, from NATO, which is supporting Ukraine. But even though folks wanted this to end quickly and expected the war to be as quick as most TikTok videos, the truth is this could end up a lot more like Korea, which is still technically at war, right? North and South Korea have an armistice in place, but there is no peace treaty, which is why the North Koreans are still occasionally firing rockets and these sorts of things, why there is a demilitarized zone that's heavily armed on both sides of it. So what could happen here in Ukraine? We might end up in a situation like that. This could be something that lasts many, many years or even decades. And I know there's a lot of news stories out there about how sick Putin is. Oh, he's got health problems. Waiting for the leader of a country that's engaging in war to die is not a military strategy. Right. At the end of the Second World War, Hitler was addicted to meth and heroin. I didn't hear Churchill or FDR or Stalin going, well, he seems really sick, hopped up on that stuff. No, that's not a military strategy. So what's going on here is a big push, continued support for Ukraine from NATO and other countries. But Russia's really been able to hold the line in a number of areas. They have lost control in some areas they had taken. That's kind of the blue shaded areas here. But this is not something that was over quickly. And of course, Russia's greatest weapon is yet to be used. And I'm not talking about nuclear weapons. I'm talking about the winter. The truth is, Russia's greatest military weapon in history has been the winter, right? They used it to beat Napoleon. They used it to beat Hitler, right? This is their thing. And about 25 years ago, they weaponized and exported the winter to Western Europe in the form of their natural gas supplies. Those natural gas supplies, which just absolutely critical for European power. If we look, the piped gas has fallen drastically since where we were before the Russian war on Ukraine. You can see this graph going back to January 2021, right? Around 400 to 425 million cubic meters a day of nat gas going from Russia to the EU. And today it's like 50 to 75. This is a massive drop-off in supply. Add to that the fact the black line here tracks with the bar chart, the stack bar chart here. The prices, the red and the blue, represent various forms of natural gas. The blue is the Northeast Asian LNG price. The red is Dutch gas. And if you look at the Dutch gas price, back at the beginning of this chart, it was around $5. Today, it's around $40 to $50. And a couple months ago, it was near $100. That's a pretty big jump. This is putting a lot of economic pressure on Europe. So Europe has high inflation, often in part because of high power and natural gas prices. And the central bank is in a tough position to raise rates. They want to kill their inflation, but this also threatens growth. High power prices, high natural gas prices, that weighs on growth opportunities, which means Europe is at real risk of a genuine stagflation. This is a huge issue. This problem might not just go away at the end of this winter. This could be a persistent risk going forward for Europe. Now, one of the ways that Europe has sought to reduce its risk profile regarding natural gas flows from Russia, the European Union has imported more LNG, including from the United States, now the world's biggest LNG exporter. We're sending our natural gas to Europe. We get cold spikes either here or there. It makes natural gas price volatility higher, something that could contribute to inflation there, something that could also risk sending inflation higher here. So this is going to be this is actually a big part of the inflation story globally. Food prices, fuel prices, natural gas, power, these costs, especially in Europe, being sent higher because Ukraine was the breadbasket of Europe and their physical commodity flows of food and grains have been disrupted. And of course, the natural gas from Russia into Europe, that's now been disrupted and has made gas extremely expensive. So stagflation on Europe's door, a really big risk, a really big challenge. Now that's one front of Cold War II. The other front of Cold War II, of course, is China. And many of you may have seen the Chinese Communist Party meeting a few weeks ago, right? And this is the first time, by the way, President Xi now gets a third term, right? This is the first time that's ever happened. And just before the vote, they escorted out the previous president, Hu Jintao. And this meme circulated on the internet. It's a line from The Godfather. Can you get me off the hook, Tom, for old time's sake, right? He was escorted out, and this was allowed to be leaked globally. What does it tell us? Well, Hu Jintao was very pro-business. He's gone. He's out. If we ever see him again, I'll be shocked. President Xi is fully in control, has surrounded himself with party loyalists, and that means the conflict with the U.S. could continue to get worse. That's actually something we've been expecting, and especially that struggle to gain deeper control and to gain full control over Taiwan. That's going to be something that China wants and pushes for. There are a couple other things, though, that could make this China-U.S. Cold War more challenging, and one of them is global debt markets. This is something, by the way, the Russia, China, U.S., NATO, that kind of Cold War II conflict, that's going to last probably many years. That will affect supply chains of goods to a great degree, something I'll talk about in a second. But it also affects global financial markets. So this is a graphic from the IMF showing debt to low-income countries, and who are their creditors? The bright blue line at the bottom is the Paris Club. Think about the US, Western European countries. The darker blue, which has greatly expanded in the last decade and a half, that's China. China currently holds 70% of emerging market debt. So China is the bank for emerging markets. And if we look at what is the debt situation, who's holding some of the other emerging market debt, well, banks in those emerging markets are holding debt at 15-year high levels. This has scared off a number of institutional investors. They're very worried, what if Russia is the preview for China? And by that, I mean Russia getting kicked out of the SWIFT banking system, ending up with lots of distressed and stranded assets. You got to write those things down. That's not good. You don't want big chunks of your portfolio turning into a goose egg. And while Russia may not have been a major, right, if you owned Russian iShares at the beginning of the year, or if you had invested in those, or if the pension or any entity that owned Russian investments, a U.S. entity, today that stuff's all worthless. Russia, not a big part of those portfolios. China, much bigger part. What happens if what happened in Russia happens in China next? What happens if China puts up a blockade and tries to squeeze Taiwan? What if there is an attempt at a military invasion, which seems less likely? A blockade seems more likely, something that, because the Chinese want to make sure that the semiconductor industry is left intact. What happens then to investments? You, your clients, the companies you serve or work with, what happens to their investments in China? If what happened in Russia happens in China, they all go to goose egg. That's a much bigger part of many institutional investor and individual portfolios. So this graphic shows from the IMF the cumulative billions of cash flows out of emerging markets, excluding China, since January, and the money fleeing China since January. And you can see there's a lot more money that's been fleeing China than there has been all other emerging markets combined. Institutional investors are justifiably scared. The risk that this all goes south is not small. We have a precedent for it. What happened in Russia? We know that China still wants full control of Taiwan. Now, the reason I'd expect a blockade rather than an outright military invasion is because Ukrainians, although they haven't taken back all the territory from the Russians, have successfully resisted most of that Russian invasion. We know that the resistance works, but we also know that Russia is rather indifferent as to what's left in Ukraine when it's over. The Russians leveled Grozny, they leveled Aleppo, and they've now put the butcher of Syria in charge of the military campaign in Ukraine. Which means the Russians don't care if Ukraine's a pile of rubble when the war's over. The Chinese want the semiconductor industry intact. They want to make sure that when they gain control of Taiwan, they want it to be fully intact and under their control for their economic benefit. That means they don't want the place leveled, which means they have to find something other probably than a direct invasion. Meanwhile, even though politics in the US seems quite splintered, there's one thing that Americans seem to agree on, and it's how unfavorable they view China. 82% of Americans currently have an unfavorable view of China, according to some recent Pew Research. 16% view them favorably. And if we look back a number of years, we look back 10 years, we look at 15 years, and there was actually a more favorable view of China than unfavorable across American voters. So this perception is also something that will give license to bipartisan pushes against China, whether it be around semiconductors or trade or tariffs, right? Those Section 232 and 301 tariffs implemented under the Trump administration did not go away. They're still here under the Biden administration. And we've seen a bipartisan push against China accelerate. This indicates that we could see this tension continue. There are some other challenges, though, we should be considering as we think about the risks of Cold War II and what does it mean for other long-term plans like sustainability. This data from the IMF shows the metals required to get the global economy to a net zero scenario in 2050. This actually shows the supply-demand ratio. The one at the left means there's 100% of lead currently being produced to satisfy 2050 goals of net zero with electrification. But if we look, there's only 60% of the copper required that's being mined annually, right? So there's a cumulative deficit that adds up. There's only 35% of the nickel and 25% of the annual cobalt or 15% of the annual graphite. There's not enough of any of this stuff. This ties into Cold War II because a lot of this stuff comes from Russia and China. This is something that could have a bigger ripple. If you have clients, companies that are setting their sustainability goals, being aware of these supply chain risks is pretty important. Moreover, I believe in the 5 to 10 year window, although it could be a little sooner, it could be a little later, there will be a time when we are not allowed in the United States to purchase and eventually use any Chinese manufactured devices with internet connectivity. That includes phones, tablets, laptops, desktops. None of that stuff. Anything made in China with internet connectivity will not be permissible in the US. It will start with many other things with government contractors. In fact, we are a DoD, the Futurist Institute is a DoD contractor. And for a number of years, one of the things on the do not use list, right up there with diamonds from Sierra Leone or pornography from Russia, right on that same list is technology from China. You can't use it if you're a DoD contractor. That eventually spills over to all government contracts, which then is big public companies and smaller entities. And then that spills over into all businesses and any state governments, local governments, and eventually you cannot use any Chinese technology in any of your work. This is coming. Cold War II implications. I know we've gone through quite a few things here, but the reason this is so important, especially for that decade ahead outlook, right, is that Russia and China have expansionist goals. They said it. They put it in black and white on February 4th, and then Russia went for it in Ukraine. Cold War II is unlikely to end soon, right? You have an unstoppable force and an immovable object in Ukraine. What does it take to get a peace deal? What does it take even just to get an armistice with a DMZ and the whole thing? That's going to be really tough to get to. Investors are very fearful that Russia's that preview for China. That's pulled money out of China with reckless abandon. And then, of course, the whole situation is a threat to electrification, net zero goals, and sustainability goals. Plus, there's an impact that you're going to see more supply chain and geopolitical problems going forward. This is just a really big takeaway. Now, as for the war on inflation, something more benign than Cold War II, in some respects, we see the Fed is raising rates. They continue to raise rates. And again, part of the reason there's so much inflation is the Russian war on Ukraine, right? Food prices high, energy prices high. Plus, there's food and energy security of supply issues in many countries. Not an issue here for the most part, but in Africa, in other emerging markets, the very high prices are terrifying because emerging markets are dealing with higher interest rates, something I'll talk about in just a second, but they're dealing with high energy prices and food prices. Those are all also dollar-denominated commodities. So now they're very strong dollar, all of that. And now you've got rising interest rates, which when the Fed raises a little, it really hits lots of other markets. We'll talk about that in a second. Fed raising rates, not done. We expect 50, 50, 25 still to come. Fed's balance sheet still very high, around 8.6 trillion, peaked just shy of 9 trillion, a lot higher than it was before COVID, which was a little over 4 trillion. This went up a lot. And of course, if we look back before the Great Recession, it wasn't even $1 trillion until the middle of until like 2009, until the middle of the Great Recession. And recently it's been close to 9, now 8.6. They have to be very careful about reducing the balance sheet. This is based on a lot of mortgage debt, treasury debt, and other securities the Fed bought. They have maturity dates. The way they're letting this fall is not by selling treasuries. They're not selling mortgages. They're not selling treasuries. They're not selling corporate bonds. They're letting things mature and roll off, and then they're not reinvesting all of the money that matures. So this is still a problem because they were the biggest buyer in the market. Now they're buying less, but they're still renewing some of the debt that matures. Over time, the amount that they will not renew will increase. And that's why this is falling. Over time, they're increasing the amount that they are not repurchasing, and they're allowing that balance sheet to burn off somewhat naturally. They're not explicitly selling in the markets. But they have to be careful, because when they did the same thing, 2018, 2019, the Fed, you'll see here, just before the COVID recession, the balance sheet was going back up. Why, pray tell? It's because the U.S. was on the verge of a recession in the second part of 2019. So because the Fed had reduced its balance sheet, the end result was the Fed had to start cutting rates and repurchasing mortgages and treasuries and re-expand its balance sheet. The European Central Bank had a similar snafu. Between mid-2012 and the end of 2014, the European Central Bank tried to reduce the size of its balance sheet, and they ended up having to massively expand it on the back end. In fact, they had negative deposit rates between 2014 and just a few months ago because of it. Better part of a decade. You gotta be very careful. This is sort of like the national debt. Everyone wants it to be lower, but getting it there, that's a tougher situation. We look at the 10-year Treasury. It's come back a little bit in the last couple of weeks here because that last CPI report where inflation was only 7.7%, but it's still 3.51%. Last year was 1.43. We look at the 10-year minus the 2-year. Ooh, this is a pretty steep widening here, the worst since the 80s, minus 0.84%. This is typically a leading indicator of recession, right? It means that the 2-year Treasury rate is 84 bips higher than the 10-year. Why would you expect money to be more expensive now than later? Well, part of it is you expect inflation will be lower later. The other reason is you're probably going to expect a recession to do that. That's what's going on here, right? Next year could be quite challenging. And of course, look, these Treasury things, if we look forward, what happens with the Treasuries and the mortgages that the Fed has on its balance sheet? This is probably going to be a lot bigger 10 years from now, because the Fed wants to bring it down a little bit, but every time there's a recession, they're going to expand the balance sheet more. This is money they just say they have. This is not government debt. The Fed just says, hey, we have this money, and they use it to buy treasuries and mortgages. But from a balance sheet, it's money that didn't exist. They just say they have it. They turn it into mortgages and treasuries, right? So, the money that doesn't exist is offset by the debt they purchased. When the debt matures, it turns back into money, but the money didn't exist, and poof, right? I mean, I feel like FTX could maybe have learned something here in the process of how to move money around in a certain way. But of course, I'm joking. But this is really a sleight of hand situation. This is not money that comes from the government. This is not tax dollars, but it works. Essentially, it's a bridge loan for the entire U.S. economy. I have had other folks describe it to me as check kiting, but whatever you want to describe it as, the amount of money the Fed has on its balance sheet looking forward in future years will be bigger because it does make recessions end. If we look at other sort of riskier interest rates, the cost of riskier credit's gone up even more than that 10-year Treasury has, right? We look at the high yield bond index, 8.42. Again, that's down a little bit, right, from what it was just a few weeks ago. But last year was 4.61. We look at triple C and lower, 15.21%, lower than what it was a couple weeks ago, 17, 18% almost, right? That it's lower, but last year was 8. So much higher cost of capital, especially for riskier credits. Also true in emerging markets. Although last year in emerging markets, the AICPA and lower EM bond yield was 14.12. Now it's 15.3. But if you look at where we were in 2021, right, 7-8%, this has gone up a lot, really, in just the last 18 months, a lot. This is putting additional pressure on emerging markets. Thinking about emerging markets, food security supply, thinking about the fact that China's their bank, thinking about with their debt, They're going to need to refi debt in emerging markets. China's your bank. This is the interest rate. Those things could make the financial situation a really critical battleground in Cold War II. It also threatens a global sovereign debt crisis, something that could happen and could have ripples that reverberate across the economy globally for many years to come. So the current economic situation overall is quite challenging, right? There is higher inflation, especially food and energy. Central banks, they're still pushing for higher interest rates. Even the European Central Bank, even the Bank of England, they are still pushing for higher rates despite their growth prospects being negative. Financial markets under tremendous pressure. And what we're seeing here is rapidly slowing global growth. And this has led some people to say only a recession can save us now. And there's different debates around what is a recession. In the US, GDP in Q3 was at a record all-time high. That does bode well. Part of the big positive for GDP is the services consumption. But Q1 and Q2 were really weak, and there were a number of different things that weakened. Most importantly, we've seen weaknesses in recent quarters, declines in investment, inventories, and goods consumption. Those continue to weaken, especially as we see a reduction in the benefit for the Section 179 bonus depreciation. That's going to be something that could weigh further on goods and investment in the first half, especially next year. 80% is still pretty good, but it's not the 100% write-off right now. Land-of-Fed GDP looks pretty good for Q4, but this is always based on available data. We could see some weaker data come in. Even though Q4 is likely now to be positive, Q1 and Q2 next year likely to be quite weak. Negative, likely. Global GDP forecast coming from the IMF. I'm not going to run through all these. You have the PDF there with all this stuff in it. Global GDP in 2021 was 6%. This year expected to be 3.2, which is still pretty good. 3% is kind of your break even from population growth here on planet Earth. But in 2023, it's likely to be below that at 2.7. Germany's already expected to have negative GDP. I will tell you, I expect these 2023 forecasts to be too optimistic. I think they're going to have to be lowered. Even emerging markets, 6.6% growth last year. This year, big slowdown, 3.7. Next year, expected to be 3.7. Advanced economies last year, a monster 5.2 for advanced economies. This year, 2.4. Next year, 1.1. So we'll be watching those pretty closely. One of the biggest changes in some of the IMF outlook for the right now is that the share of global economies that are expected to see recession has gone up a lot. Back in January of this year, the IMF was expecting less than 5% of all economies in the US would see a contraction of 2 negative consecutive quarters, either this year or next year. As of the October report, it's around a third. Manufacturing's weakened as well. We now see manufacturing, a key leading economic indicator. I know manufacturing is a small part of both the labor force and the economy in the US, as well as in Europe, but it's a really important capital-intense leading indicator of GDP growth. And what we see is Europe, Eurozone, and China, the break even for these purchasing manager indices, these are surveys of purchasing managers who work in manufacturing, break even's 50. The blue line is the US. The green line is the Eurozone. The red is China. China has been below the break-even line for 9 of the last 13 months. Europe has had several consecutive negative declines, and the US was below the line in the most recent month for November for the first time since the earlier part of 2020. This is not good. If we look at the aggregate, again, they each have a break-even of 50. There's 3 of them, break-even's 150. You can see the contractions where we are right now. Now, if we think about the headline and trend line with all of this, PMIs are always going to be a pretty good leading indicator of growth. We don't know where things are going because they are a leading indicator of what capital is doing. And what we see is China, Europe, US quite weak. Another important leading indicator that's likely to remain important is consumer confidence. It hit a record low in June of 2022. You can see it here on the right. This is a series of 7 years of data. And it bounced up, and now it's back down a little bit, but it's still near record all-time lows. That means consumers, which are responsible for 70% of GDP, 70% of GDP comes from consumers. If consumers aren't confident, that's not good. They are less confident now than during the financial crisis, during COVID, also less confident now than during the Vietnam War, during the Cold War, when the Berlin Wall went up, during the Bay of Pigs invasion, during the Cuban Missile Crisis, right? Consumers are super not confident right now. They're scared. Part of it is they've seen a wealth effect reverse. And that's something called the everything sell-off, right? We saw the everything bubble and everything went up. And what's happened here is, right, borrowing money is expensive, which has reduced profits. Higher interest rates have made valuations fall, right? Equity analysts using discounted cash flow models, those of you who do valuation work, right? Higher interest rate, higher weighted average cost of capital, you get a higher WACC, and that weighs on your valuations. Math. Less risky investments then become more attractive. The implication and the impact is there should be a strategic focus on cash flow, and there's likely to be some emerging tech consolidation and failures. We're beginning to see some of this. But let's talk a little bit more about this everything bubble. This is the Dow Jones Industrial Average. You can see the big run-up during the drop in COVID, the big run-up, the sell-off, and now bounce. Very different for the NASDAQ. Big run-up during COVID, and now just a giant sell-off. It's struggling to rebound. Gold prices also, solid run-ups, but now sold off a little bit, bouncing a little bit. Sorry, this isn't steel prices, it's actually the Baltic Dry Index. If we were to put up hot rolled cold steel prices, we would see the same dynamic. Prices have come back down from where they were very, very high. But this is a proxy for shipping, proxy for metals in many ways. Baltic Dry Index, shipping costs really come down. The dollar is a pretty big exception. This is actually, we can see this goes all the way back, decades. And we can see the dollar index traded on the NYBOT, the New York Board of Trade. Right now, very recently has been at the highest level since the early 2000s. And yes, it's come down in the past month because of that weaker CPI report. It's still pretty high. Got to see what happens in Europe with their growth this winter and what happens with their inflation situation. That's going to be really critical for the dollar going forward. And then there's crypto, right? So the big thing with the magic internet money that I try to tell people, I've been telling people for some time, the most important thing you can know is that you can't spell crypto without cry. Addition to that, though, especially as folks working in the accounting space, it's important to know that this time is never different. In the same way that crypto was originally designed to obfuscate where funds are moving, to be sort of an anonymized way to engage in large financial transactions, there has been something we already saw like this. This is a bearer bond. They were largely banned in the 1980s. But up until that point, if you had the bond, if you were the bearer, you walked into a bank and you got paid. They went away because the KYC AML anonymity issues around using bearer bonds. And yet we came to a digital conclusion, which brings me to something that I think is really important. My personal favorite holiday movie revolves around all of this. And that's actually Die Hard, right? Because the main plot point of the movie is that Hans Gruber is trying to get these analog paper precursors of crypto. That's your plot point. So this stuff's been around. We've seen how this plays out. More regulation is coming. What's the decade ahead hold for crypto? Well, I'd love to know your thoughts. I actually did a LinkedIn poll just today on this. What will people look back at the future and think of crypto today? Right? Was it a criminal scam? Was it digital beanie babies? Or as the CEO of Jamie Dimon had said, it's pet rocks? Or is it, is it the beginning of a great change? Or is it just a punchline of a joke? How will people look back at crypto? I suspect a criminal scam that's a punchline of a joke and digital beanie baby. I assume that's all one thing mashed together. This has actually been a key point of a book that I wrote, came out in 2018, called The Promise of Blockchain, Hope and Hype for an Emerging Disruptive Technology. And I talked about this, that blockchain as a technology is essentially accounting software, has many different kinds of high value uses in certain corporate cases. Think about supply chain and other record keeping across distributed but trusted limited network organizations. Fine. But crypto, that's where the hype is. And I asserted at that time digital beanie babies. And I still stand by that. Those are things we're going to see, I think, come under more pressure. A lot of regulation and oversight are coming for that stuff. The IMF is doing a call tomorrow about it. We're going to see a lot more regulation, I think, come out globally around crypto, just as we did around bearer bonds. So let's talk about now something that's going to be a bit more positive as we think about the outlook for the decade ahead. When we were in the middle of the global financial crisis, housing was a major risk and it caused a lot of pain. The question is, did we learn our lessons from the housing crisis? And the good news is, despite the rise in interest rates, we have learned our lesson. And even though rates have gone up, we might be in a much better situation and position than we were than during the housing crisis. Let me give you an example. So fixed rates, around 6.5% now. They've gone up quite a lot. They've come down just a little bit from where they were in recent weeks, again, on the back of the slightly weaker inflation numbers. But if we look at the credit scores, they've never looked this good. Mortgage credit quality here is shown by quarter. The stacked bar charts reflect billions of dollars allocated to each credit score. And what we see is, on the right, there's this giant mountain of blue. These are the quarterly issuances of mortgage debt, with the blue being 760 plus credit scores. On the left, you can see the 760 plus credit score is a much smaller percentage, right? A quarter, a third of all mortgage issuances. On the right-hand side of this graph, during the COVID period, with super low interest rates, 2/3 to 3/4 of all mortgages issued were to people with 760 plus credit scores. Those kinds of credit scores do not fall out of the sky, which means even if the job market were to turn, again, unemployment rate's 3.7. There's millions of people shy of what the labor force needs, right? There's a lot more open jobs than there are people to take them. And layoffs, even though they've gone up, we see the number of people filing for unemployment is really, really low. So the labor market's really good. We see that mortgage origination credit scores very high, highest ever. And then if we look at overall sort of consumer delinquencies, they're near record lows. You're talking 2.5% to 3% of all household debt is delinquent. And that's been the case for the last 6 quarters. By the way, this debt, these delinquencies, the color is by how late the debt is and how delinquent it is. But the big thing here is this debt includes mortgages, HELOCs, credit cards, auto loans, student loans, everything. And in the last 6 quarters, 2.5% to 3%. At the peak of the housing crisis, this was almost 12%. We are relatively deleveraged, relatively low debt delinquencies, very high credit scores for mortgages. It looks like we learned some of our lessons in the housing crisis. I would also add to this a couple things. One is, fine, home prices are stagnant, home prices are down. What do? Rent your house out. Rental vacancies are currently at the lowest since 1984. So there's a demand for housing. There's no vacancies. There's not a lot of supply. And if we look at rent rates, obviously, with a lack of supply and strong demand, people have jobs, they need a place to live. Rents up year on year 7.5% in August. So actually, that might be September, sorry. 7.5% is the current data for year on year. So we're looking at very high levels of inflation. I apologize, that's October. This is the most recent data. This is 7.5% year on year. October's the most recent data we have. November, we get on the 13th. But the big point here is vacancies are low. Rates of rent up 7.5% year on year for the most recent data available in October. Key economic takeaways overall, if we're thinking about what's going on now, how does that shape the decade ahead? Strong jobs, strong inflation, the Fed is pushing ahead. If we think about those demographic changes and shifts we're going to see, the labor market could be really quite tight for quite some time as we're seeing a secular change in baby boomers leaving the market. This could give the Fed license to raise rates until we see inflation ease. The economic outlook is slowing. We do expect weaker growth, especially next year, especially for investment, especially as we begin to see a reduction in the Section 179 benefit. Cold War II is unlikely to end quickly. That could cast a shadow for many years, decades even to come. Bond yields have risen. They've come back down a little bit in recent weeks, but they're still very high. They could bounce further with economic, financial market, and geopolitical implications, even if they just remain at current levels. This presents sovereign debt risks, especially in emerging markets, which is why, even though it looks like good news, we learned from the housing market crisis, global debt crisis looms with supply chain procurement implications. And as we think about sort of how do the different technology pieces fit in this, right? Cold War II presents a threat to some of the sustainability and green technologies, even though there's going to be a bigger push there. If we think about what technologies we're going to see around labor, the fact that we've got this secular shift for labor where we're seeing the generational churn, we're likely to see a much greater need for automation across the entire economy. AI as well as physical robots. Some of that robots can do. There are many things in person they cannot. I think specifically about healthcare and trades. All of those things are going to be part of what we see going forward. And so right now, as I think about sort of the uncertainty that dominates what we see in the global economy, it's really important to face the challenges we have head on. Looking out longer term, there's going to be positive growth. But for now, this is a time really to focus on ROI and minimize cost. Encourage your clients, any of the companies you work with, anyone you're advising, focusing on ROI and minimizing costs is going to be really critical right now. Do I think inflation will get down? Yes. Do I think that some of those bond yields will eventually be lower? Yes. But for now, that higher cost of capital means cash is once again king. Accounting for sticky inflation is going to be really important. This is also why it might take a year or two to really get back to more normal rates of inflation, because with high inflation, that begins to get written into business contracts, labor contracts, all other kinds of things, makes it very difficult for prices to ease. And by the way, even if inflation eases, that doesn't mean prices go down, right? This is a second derivative issue. We still think prices are going to go up, but they might go up at a much slower pace. We do not expect prices will reverse back down, generally speaking. The other thing, of course, is to be cautious with speculative investments. The mantra for many companies, especially in the tech space, where the more you lose, the more you're worth, didn't make a lot of sense with a Fed funds rate at 0, makes crazy no sense with a Fed funds rate that could be 5% or more. Also, preparing for a protracted Cold War II. This is really important. Technology supply chains are going to be forced to serve one of two masters, either China or the United States. Even just today, big announcements of funding coming out of the Pentagon or the government, more defense spending around technology. We're going to see a lot more decoupling, not just of supply chains, but especially of technology and dual use supply chains, decoupling, further pulling apart China and the US as end markets, being forced to choose one. And then focusing on operational resilience and cash flow. I can just not stress that enough. That is absolutely paramount to success in the current environment. And with that, I would now turn to the disclaimer. I know you're all going to read it diligently. Everything could be wrong. And then that's me, my contact info, my personal website, my LinkedIn website. That'll take you right to my LinkedIn. And yeah, happy to open it up now for Q&A. Thank you all very much for being here.
Thank you so much, Jason. I was monitoring the chat and have to say the consensus was this is one of the best presentations they've heard on the economy, and people really enjoyed it. And so you have a lot of questions, which we're not going to get to all of them because we have about 7 minutes till the next sessions. But I wanted to mention two of them that might be related that had the most votes, which is, one is how can people just leave the labor force altogether? How are they meeting their basic needs? Are these people who are getting close to the retirement age? And then I don't know if it's related, but why aren't the employment statistics taking part-time workers into account? Because it seems like a lot of people have side gigs in addition to their full-time jobs, or may work multiple part-time jobs.
Yes, so thank you for the question. So there's a few different pieces to this. Let's start with labor force participation rates. So labor force participation rates The labor force, let's define it. Population is everybody who lives in the US, right? 330 million people like that. Then there's the civilian non-institutional population. So that's every man and woman 16 and up. No limit on the upper end of age. Everyone 16 and up who's not in the military and not institutionalized, so incarcerated, a mental facility, anything like that, right? So we're talking everybody 16 and up who's not one of those special categories. That includes people who are 110 years old, and it includes people who are 16. What we've seen for labor force participation rates are a few things. For people ages 16 and up, the labor force participation rates peaked in the 1970s. They've been going down for decades. Why? We wanted people to graduate high school. For people ages 20 to 24, it peaked in the 1980s. It's been going down for decades. Why? We wanted people to graduate college. But prime working age is 25 to 54. Well, that's the part that's really the question. There's something like 1 in 9 men in that labor force category, 25 to 54, is not working. And if we look back a few decades, 4 or 5 decades ago, it was 1 in 50. So what happened? Where did those men go? Where it's 1 in 9 who aren't working instead of 1 in 50. And there's a report that came out about this. Boston Fed released it. There's a link in my LinkedIn profile about this. And it's a report, you can just look it up. The big thing is there's a couple pieces, and it's people without college degrees who are 25 to 54 who are men. And the argument statistically is a perceived loss of status and wages that didn't keep pace. And you also have a lot of people going out on disability. And those folks have just left. So that's what's happened in the labor force. Those aren't retirees. Now, retirees, people 55 and up, that labor force participation rate's been going up since around 2000. But it's lower than it was before COVID. Why? Well, the generational shift, because there's so many baby boomers that as they leave, there's a lot of folks over 55. There's a lot more folks over 55. So the percent of them still working is smaller because we're talking just a bigger cohort of people over 55 because of the size of the baby boomer generation. So this is all kind of weird math stuff, but that's the situation. Again, if you want, I posted on LinkedIn yesterday, there's like 75,000 people have viewed it, hundreds of comments. There's links to the whole thing. I would probably recommend you take a look at that. That'll link you right to the story. But the big takeaway is these are sort of labor force dropouts, and it's another argument in favor of education. And I really have come to believe the argument that you don't need education. You don't need to go to college. College doesn't matter. Education doesn't matter. This is a ridiculous argument that a lot of people find very attractive to hear, and it gains a lot of traction. It does not serve really the folks who are hearing this and are receptive to it, because the truth is you're here for continuing ed, right? Like you're professionals, I'm professional, right? I have continuing ed requirements. All of this stuff is, the reality is that statistically, yes, there are people who don't go to college, do very well, and that might drop out of college and do very well, right? People love to point to Bill Gates or Mark Zuckerberg. But the truth is, on average, across the whole economy, more education turns into more money every single time.
Makes sense. And I'm sorry that we're so short on time. There are more questions. Okay. I'm hoping I can share them with you. And if it makes sense that you can respond to those, we can email people or figure out an answer there, or just bring you back again. But
sounds great.
Thank you so much. We really appreciate your time, Jason.